As an investor, you must have heard numerous explanations about diversification. Here is our practical, no BS take on diversification and how to diversify your stock portfolio, as well as our 5 best stock ideas to help you start building a diversified stock portfolio. Stay tuned. Hey, before we start, real quick, what is diversification in your mind?
I think it's the age-old conventional wisdom. Do not put all your eggs in the same basket.
Yeah, that's right. And actually, the first layer of diversification is to think about investing across asset classes. Now, there are multiple asset classes. Stocks, everybody knows, that includes individual stocks, ETFs, mutual funds. And secondly, real estate, that could be the home that you bought, or rental houses that you bought, or even crowdsourced real estate investments such as CrowdStreet. The third type of assets could be alternative investments. These could include things like art, expensive cars, private equity, venture capital, foreign currency, and cryptocurrency, etc. A lot of these alternative investments, though, are hard for new common investors like you and I could access, unfortunately. Another type of asset class is what we call fixed income. This could include US Treasuries, the I bonds, corporate bonds, or even CDs that are FDIC insured. Last but not least, don't forget the cash, the things that sit in your checking account. Now, the stocks, real estate, and alternative investments or asset classes, they are usually considered higher risk investments or asset classes. And fixed income or in cash, they are lower risk asset classes. How to allocate your money across these asset classes typically depends on your time horizon or risk tolerance. For example, if you are a retiree that depend on investment income to maintain your lifestyle, you probably want to skew more towards lower risk in terms of asset allocation. But if you are a new college grad that just started your career, you probably want to focus on more higher risk investments like stocks. Although the concept of diversification could apply across asset classes, today we are going to focus on diversification for stock portfolio. Diversification is a key strategy for stock investors. Why? The objective is twofold: to optimize your investment return and at the same time balance risk and volatility, especially to mitigate downside risk. Let's take a look back in time to demonstrate the power of diversification, as history speaks for itself. There's an interesting analysis done by MFS looking at average annual return of different types of asset classes over the past 20 years, from 2002 to 2021. There are 10 different colors here, and each represents an asset class or a different type of underlying investments within asset classes, such as stocks and bonds. Within stock, you have large cap growth or small cap growth. If a color box sits on top of the chart, that means that particular asset class generated the highest annual return within that particular year. If a box sits at the bottom of the chart, it generated the worst return in that particular year.
So basically, no one particular type of asset class or underlying type of investment performed consistently across the last 20 years. They keep moving up and down depending on the underlying economic cycles. Let's take a look at the performance of different type of these 10 asset classes. So if you look at the average annual return of these different types of asset classes, the large cap growth stocks such as Microsoft, Amazon, Netflix, Salesforce, they perform the best on a cumulative basis over the last 20 years. They generated around 11% in average annual return. Looking at the historical performance of this basket of stocks, it's very volatile. You can see the ups and downs. For example, they bottomed out during the 2008 financial crisis, and then they recovered very well. And then, however, they underperformed, and then they came back up after the COVID crisis. Looking at another example, the REITs or real estate investment trusts. Once again, the story is similar. They are very volatile, but counter opposing the performance of the large cap growth stocks, especially during the COVID crisis. You can see how they dipped because of the pandemic related behavior. The third example we want to discuss is the commodities. Once again, similar story, very volatile, and then bottomed out during the COVID crisis, but came way back up after the recovery. However, if you own a diversified portfolio of stocks and bonds and alternatives and commodities, you could see that the performance is much more smoother and less volatile over the last 20 years. Now that we already looked at the average annual return of these 10 asset classes, now let's take a look at what is the underlying risk associated with each of these asset classes. It is measured via a metric called standard deviation, which is basically how volatile that asset class is. So the higher standard deviation means higher highs and lower lows. So these type of stocks tend to be very volatile and goes up and down. On the other hand, if a number of the standard deviation is low, that means it is less sensitive, so less risky. So we looked at large cap growth stocks, which have generated a 10.86%, the highest average annual return in the last 20 years. However, their risk is also high. So high risk, high reward. On the other side of the spectrum, there is cash producing the lowest return of only 1.23%, but also carries the lowest risk of only 0.42 standard deviation. Another asset class which is safe is bonds, producing a lower return of 4.33 annual return, but also carries low risk. So low risk, low reward. And then there are some asset classes such as commodities that doesn't have that much of an attractive return in the long time frame, but they do carry a lot of risk.
Yeah, but that doesn't mean that you cannot make money out of commodities. It simply means you need to be very skillful to time the market right in order to capture the higher highs. Let's also take a look at the power of diversification within a stock portfolio. This interesting study compares market return versus a several stock portfolio ranging from a 1 stock portfolio, a 15 stock portfolio, and a 30 stock portfolio. Looking at the 1-year return of these stock portfolios, if you own only one company or one stock, your return can range from -80% to 96%. It's like buying lottery. You don't know if you will end up with a $200,000 portfolio or you end up with a 20K portfolio with a 100K initial investment. However, if you own a 15 stock portfolio, that range of return narrowed to -3% on the downside and 19% on the upside. If you further diversify your stock portfolio to 30 stocks, that return range further narrowed to 0% to 16%.
For retail investors, it is difficult to choose one stock or a basket of 10 good stocks. So ETFs and mutual funds do offer this diversification benefit.
However, if you want to achieve above market return, which is around 8% a year, you may want to pick the best in breed stock to include in your diversified stock portfolio, which is what we do here at SafeSea.
Now that we established the importance of diversification, let's take a look at how to build a perfectly diverse portfolio. The first thing we would suggest is diversifying across the industry sectors, across the US economy. The second dimension is based on the geographic presence where the company generates most of its revenue, whether it is domestic or across international. The third one is how big the market cap or the market capitalization is of that particular company, whether it's a large cap or a mid cap or a small cap. The fourth one is based on its growth cycle, meaning it's a established company with moderate growth but generating high income, or a moderate growth with established company with moderate growth but no meaningful income, or a aggressive growth company, meaning the top line growth, revenue growth is phenomenal but not meaningful income. The fifth dimension is the particular business stage or the maturity of the company, whether it's a early stage startup company or a mid stage company, meaning established in the last 20 years with a proven business model, or a mature company, meaning like 40 years old, very well established, with meaningful revenue and top line, bottom line. The last one is how the style of the company, meaning whether that particular underlying stock acts as a offensive stock, meaning it proportionally overperforms the economy during good economic cycles, or it acts as a defensive stock or a defensive company, meaning like consumer staples. During downturns, it acts as a hedge.
So overall, we want a mix of stocks that cut across all 6 dimensions we just mentioned. And as a reminder, at the end of the video, we'll use this exact framework to present 5 best ideas we have to help you build a diversified stock portfolio.
End of the day, the key goal of diversification strategy is to optimize your return, but also manage your volatility and risk of your overall stock portfolio. So you can diversify or you can buy stocks across these different dimensions, basically across industry segments or sectors, companies that are both domestic and also have international presence, or how big they are, or how fast they're growing, or whether they are mature companies or early stage companies. But end of the day, to manage diversification, the key goal is understanding whether each of the stocks that you own or want to own are acting offensively or defensively against the economic market cycle.
Yeah, that's right. By owning a good mix of stock across offensive and defensive style, you basically can capitalize on the upward swing of economic cycle while protecting yourself during the down cycle.
Now that we talked about the importance of owning both offensive and defensive stocks, let's take a look at which type of industry sectors are defensive versus offensive. In the defensive sector, meaning, for example, take consumer staples like your groceries, toilet paper, milk, diapers, bread, or healthcare, meaning your health insurance or your drugs or medicines, or utilities like the electricity and heating. Those are considered defensive sectors, meaning you need these type of products regardless of economic cycles. On the other hand, there is the offensive sector, such as technology, industrials, financial services. These companies, they grow, or these industry sectors, they grow with the overall economy. When the economy is growing well, they tend to typically do relatively much higher, much better.
Yeah, because when consumers and companies have more money, they have extra buck to spend on the services and products.
That's right. Let's take a look at offense versus defense in action. We looked at how the consumer staples industry, which is a defensive play, versus the discretionary, which is an offensive play, how the companies in these two sectors performed in the last 10-12 year period. We all remember in 2008, there was a huge financial crisis caused due to the real estate meltdown. In that particular down market economy, you could see that consumer staples performed relatively well, actually much better than the discretionary and even the broader S&P 500. So the defense coming into action. Another down year, 2019, once again, the defense sector performed well. But whenever there is a rebound in the economy, for example, 2009, 2010, or 2013, when the market performed really well, when the economy is good, the discretionary sector, meaning the offensive sector, outperformed.
Fast forward to year 2022, which is a year of bear market and record inflation. The style of offense and defense is on full display. For example, Walmart and Kroger, classic defensive stock in the consumer staples sector, meaning they sell a lot of food items that you have to buy regardless of economic condition. And then Target and Nike, which are classic offensive style stock, which sells a lot of apparel, shoes, or lifestyle goods in the consumer sector. And so take a look at their performance this year. Kroger and Walmart both are in the green. And then Target and Nike both are deep in the red, declining by almost 30%. So 2022, if you own a defensive stocks like Kroger and Walmart, that's going to balance your portfolio out and avoid catastrophic loss.
One of the most frequently asked questions is how many stocks to own to build or to construct a well-diversified portfolio. One of the golden rule of thumb is the 5% rule, meaning any one stock in your portfolio shouldn't comprise more than 5% of your overall portfolio. So, which means a good diversification can be built by having at least 20 stocks in your portfolio that cut across the sectors, that cut across the industries, basically what we just discussed.
Building a well-rounded stock portfolio could be overwhelming for investors. Here are our 5 best ideas on foundational stocks to help you start your journey. Salesforce in the technology sector, Zoetis in healthcare, Eaton and industrial stock, Costco consumer staple stock, as well as JP Morgan Chase in the financial service sector. We have analysis on all of these 5 stocks on our YouTube channel. Don't forget to check it out. As promised, let's use our 6-dimensional framework to assess the diversification benefit of these 5 foundational stocks. As we mentioned, these 5 stocks span across 5 different industry sectors. In terms of geographic presence, some stocks like Eaton and Zoetis, they are highly international, with around half of their revenue coming from international. On the other hand, we have US-centric business such as JP Morgan and Costco, with around 1/4 of their revenue coming internationally. In terms of size measured by market cap, you have a wide range of market cap across these 5 stocks, with Eaton at $65 billion, and on the other end, Costco with market cap of around $240 billion. In terms of growth profile, you again have high growth companies such as Salesforce with top line growth at double digit. And on the other hand, you have companies that focus on stable growth while high profitability and high return of capital such as dividend to shareholders. These include JP Morgan and Eaton. In terms of business stage, you have mid-stage companies like Salesforce with 20 years of operational history, and then on the other hand, you have mature companies like JP Morgan and Eaton with more than 60-70 years of operational history. Lastly, let's take a look at style. We talked about offensive and defensive style, and based on the stock's sensitivity to economic growth and market performance. Typically, we use a metric called beta to measure the sensitivity of the stock compared to broader market performance. For example, a beta equal to 1, meaning the stock tend to rise or fall at the same percentage versus the broader market, such as S&P 500. With a beta more than 1, that means the stock fluctuate more compared to broader market. While on the other hand, with a beta less than 1, the opposite is true, which means stock tend to fluctuate less than broader market. And so as you can see, Offensive stocks here tend to have a higher beta more than 1, while defensive stocks tend to have a lower beta less than 1. And so among these 5 stocks, you have offensive, more sensitive stocks as well as defensive, less sensitive stocks such as Costco and Zoetis.
Depending on your financial objective and risk appetite, you don't have to, you can adjust how much money you want to put in one or two of these stocks as opposed to spreading out equally. For example, let's say you have $10,000 investment you want to make across these 5 companies. You don't necessarily have to put like 2,000 in each of these stocks. If you're a growth oriented investor and you can take in some risk and volatility, you could go and invest a majority of that $10,000 into these high growth companies such as Salesforce that has more room for growth. But if you are somewhat defensive in nature and you don't want to undergo that market volatility and you don't have that risk appetite, you can instead put more of your $10,000 into companies such as Costco and Zoetis that are more defensive in nature.
As a serious investor, it's important to understand the stock and the underlying company's business fundamentals. To help with this, we have videos on each of the stock as deep dive analysis on our YouTube channel SafeSea. Follow and subscribe to us to learn more.